The most profitable trading strategy on Wall Street is probably already dead. It just doesn't know it yet. The most powerful hedge funds in the world have spent a decade building quant strategies, computer-driven approaches to finding patterns in markets and turning them into profit. For a while, they worked brilliantly, but something is eroding these strategies from the inside. Not a market crash, not regulation, something far quieter. And understanding it reveals which firms will dominate the next decade and which will quietly disappear. By the end of this video, you'll understand something about markets that most people on Wall Street still haven't fully reckoned with. Let's start with what these strategies actually are, because the jargon gets thick fast, and I'm not going to let that happen here. A quant strategy simply means using math and data instead of human gut instinct to decide when to buy and sell. You're replacing the intuitive trader with a rule-based program. The classic version runs on 3 core signals. Value, buying assets that look cheap relative to what they're actually worth. Momentum, riding assets that are already moving strongly in one direction. And carry, collecting the extra return you get just for holding certain assets, the way you earn interest on a bond. Those 3 signals. For decades, that was the game. Then machine learning arrived. Suddenly, instead of 3 signals, algorithms could process thousands. Satellite images of retail parking lots, patterns in news headlines, obscure correlations nobody had ever thought to look for. The strategies got far more powerful and far more crowded, which is exactly where the problem begins. Here's the uncomfortable truth about any strategy that works. Once it works, everyone copies it. And when everyone copies it, it stops working. This is called crowding. Machine learning tools that once cost millions are now available to almost anyone. Data that used to give one firm an edge is now sold to hundreds simultaneously. The result? Thousands of sophisticated algorithms running the same playbook. When they all try to exit the same trade at the same moment, because they're reading the same signals, you get sudden, violent crashes with nothing to do with the economy. Just algorithms fighting algorithms. The old signals aren't just crowded, they're decaying. Their ability to generate reliable profit, what analysts call information ratio, has been falling for years. Strategies that built fortunes in the 2000s are becoming what investors call beta, which just means returns you could get from a cheap index fund. Nobody pays hedge fund fees for that. But here's where it gets stranger. The biggest threat to these algorithms isn't better algorithms. It's coming from something called zero-days-to-expiration options, or zero-DTE. Simple translation? An option is a contract giving you the right to buy or sell something at a set price. 0 days to expiration means it expires today. It's a daily lottery ticket on market direction. These contracts now represent nearly half of all daily options trading on US indexes, and they've fundamentally changed how markets move within a single day. When millions of these contracts are traded, the banks selling them must constantly hedge by trading the underlying stocks in large, predictable patterns. This creates invisible price zones where markets get pinned before suddenly releasing. Traders call them gamma gravity bands. For an algorithm trained on weekly data, these intraday movements look like random noise. They're not. They're a new regime. And firms whose models ignore them are trading blind inside their own blind spot. This is where Foresight becomes useful, because the future here doesn't lead to one destination. It splits into 4 paths depending on 2 things nobody can predict yet. Question 1. What drives returns? Big macroeconomic cycles or fast intraday microstructure dynamics? Question 2. Can winning strategies scale to billions or only work small? In the quant renaissance, macro regimes stay long and stable. Large platforms scale ML beautifully. The biggest funds get bigger. In sovereign macro, geopolitical chaos overwhelms pure algorithms. Hybrid firms, human judgment plus systematic execution, win. In crowded infrastructure, microstructure matters, but the tools democratize so fast that everyone's signals become identical. Infrastructure providers win, strategy firms break even, and then the 4th future. The most likely one at 40 to 50%. In adaptive micro-alpha, classic signals become commoditized, cheap and available to everyone. Real profit only comes from exploiting fast-decaying quirks, patterns from options dealers hedging, fragmented liquidity, the daily rhythm of same-day expiry. The catch? These opportunities vanish in weeks. The moat isn't finding a good strategy. It's detecting when your strategy is dying before anyone else can see it. 3 things to take from all of this. 1. Classic quant signals aren't vanishing overnight, but their edge is being quietly extracted. If anyone sells you a momentum or value strategy as a differentiator, ask them what their signal half-life is. How long before it stops working? 2. Firms positioning to win are investing in the actual plumbing of markets. Options flow, order book patterns, real-time execution intelligence. Different skills, different data, different infrastructure than traditional quant work. 3. The single best leading indicator? Watch whether small boutique funds continue outperforming large quant platforms over the next 2 years. If that gap widens, the adaptive micro-alpha future is arriving in real time. Here's the final sting. The firms most at risk aren't the ones that haven't adopted machine learning. They're the ones that adopted it flawlessly and stopped there. In a world where everyone has the same ML tools and the same data vendors, the competition is no longer about who has the best model. It's about who knows their model is obsolete before anyone else does. The future of alpha isn't a better algorithm. It's a better early warning system for when your algorithm is already gone. Which of the 4 futures do you think plays out? Drop your pick in the comments. Next week, we go inside the actual infrastructure you'd need to compete in the adaptive micro-alpha world. And the numbers are more accessible than you'd expect. Click like and subscribe not to miss it.